Hello traders and welcome to another strategy video of mine. So in today's video we'll be talking about the emotions of trading. Reason I'm doing this video today is because it was the most suggested video that I had on my Patreon. For those who don't know, Patreon is a paid service where members can vote and suggest future videos that I will be making for around $3 to $5 a month. Okay, so and this video had 100% of the votes actually. To start, let's talk about three things in this video. Emotions within the market, then let's talk about these emotions that are visualized in the market, and then finally, let's talk about strategies that you can use so that you cannot make the same emotional mistakes that these guys are making. So, complete the sentence. 90% of trading is mental. You've probably heard this many times before. 90% of trading is emotional, mental, in your head. It's all true. The market does run on the psychology of the market participants in where buyers think it will go and where sellers think it will go, and the interaction between those two. So what we want to do is eliminate our emotions in the market, but at the same time recognize other people's emotions in the market. If you can do that you can understand the market psychology but also understand your own psychology, then really your profits will be limitless. So let's talk about the two main emotions that we see in the market, fear and greed. So fear typically occurs when the market is crashing. And as the market is crashing, everyone just panic sells. And then you get to a point that's oversold, and then the market moves upward. And we're going to get into reasons of why exactly that happens. Greed's the opposite. So we have the market skyrocketing, and then all those sideline market participants who are not holding positions all buy all at once, and they bloat the market, and then the market goes down. I know it might seem a little confusing that if everyone buys, the market goes down. If everyone sells, the market goes up. But the reason why these happen are near the end of a trend. Near the end of a downtrend, we have a lot of fear, and near the end of an uptrend, we have a lot of greed. But at the beginning of an uptrend, you need to see a lot of buyers. And at the beginning of a downtrend, you need to see a lot of sellers. So I know that might be a little bit confusing, but basically just think that in an established trend, that's, let's say, moving upward, you see that many people buy all at once. That's a really bad sign. That greed might be taking over the market. Now let's look at some visualizations of this mass market and fear and greed, mistakes being made in these mass markets. So what we're going to do here is look at some examples of fear and greed as price moved up and down. All right, so to start off with, this graph is not as complicated as it might look. In blue, we have Bitcoin price, as you can see right here. And in green, we have how many Bitcoin are being held by long positions or held by buyers. That 100%, ignore it. So yeah, let's begin. So we see here that we have about, price is about 6.1K, and we have about 27K Bitcoin being held by long positions on Bitfinex. Now look as the market moves upward. As the market moves upward, we can see that long positions are moving down very rapidly, which doesn't really make a lot of sense when you expect that as the market moves up, you'd get more buyers accumulating. Well, that's not really the way that the market works. It's not a rational market. And the reason why you might be wondering, well, why does this happen? This doesn't make sense. This happens because all these buyers who were long are selling because they're taking profit. And they're using their fear of losing the gains they've already made right here. All that fear is coming in, and they sell around this point right here when they could have made much more profit from, like, if they had sold around 680, they could have made around actually $1,000 more dollars more if they had just $1,000 of Bitcoin worth more if they had just held on their positions. But because of all the take profiting, that doesn't happen. Mistake number one, fear. Mistake number two is extreme greed, and this is probably the most important example I'm going to be making in this video. Because if you see this in the market after an established uptrend, that is a horrible sign, and a good sign that you should be shorting the market and trading against the herd. Look here. So we have uptrend, consolidation, we have resistance here. That will become very important. And then with that resistance there, we have a spike right here where price moves above resistance and then crashes. Why does this happen? I don't get it. Well, the reason why this happens is because, look here, we have about 18K Bitcoin being held by long positions. As that spike happens, we go to around 22K. That's 4,000 increase in Bitcoin held in long positions, all in a few hours in an established uptrend. This bloats the market and puts us into an overbought condition. So we can see that right here. This $200 increase in price had a 4K increase in buyers. And then this little spring occurs, and then we have a crash immediately following it. But during this crash, those Bitcoin buyers, they're not falling, which would be rational, copying the market's moves. Instead, they increase as the market moves down. Reason why this happens is again, greed. The market's moving downward, but these traders are greedy. They do not want to be taking out at a loss, so they hold. And then other traders see the market moving downward and see potential buying opportunities, and then they buy, and we get all this. So we go from, let's say at the beginning of this downtrend, we go from about 20K Bitcoin to around the end of the downtrend, we go to around 25K Bitcoin. So as price moves down, 5,000 more Bitcoin have been bought in long positions, which is completely irrational, but just the way that the market works. So this opposite market psychology you can see in this market. And then just a quick note, we can see this in the shorts as well. Same thing here, nothing to be afraid of. This is just short positions. Look here. So we have, first we have some greed. So we start here, and as price is moving up, we have about 20K short positions, short Bitcoin held in positions. As the market moves up, we can see that shorts increase. And then when we get around here, we have about 28,000 Bitcoin being held in short positions, which is just so strange that as the market's moving upward, the shorts keep on shorting. And again, this is just traders not wanting to take a loss. And then you can see another market mistake as the market begins to move down, and in these guys' favor, instead of holding on the positions actually making money, they all sell and dump their positions. Look here. We go from around that 28K, and then as the market's moving down, we go all the way down to around 12K. So more than half of these positions that have held Bitcoin short have liquidated, have exited the market as the market's moved down. This is just the way that the market operates, with usually the mass market doing the opposite of what the market is actually doing. And then one last note before we go on to strategies that you can use to not make these kinds of mistakes are right here. You can see that we have around 22.5K Bitcoin right around here. And then all at once, we go to 12K. So around 10K Bitcoin were covered or bought back because these are shorts. This is another massive mistake that occurs right here as everyone just liquidates their shorts. And as you can see here, let's for about 20 seconds, let's just talk about what you can learn from this. Well, what you can learn from this, just beyond the as markets moving down, shorts for some reason are moving down as well, this counter-cyclical stuff, is that the more important part is that what happens all at once, which happened right here, and which also happened right here. When many traders in an established downtrend or established uptrend all decide on one opinion, that's when the market rejects that opinion and goes the other way. So basically, when everyone buys and everyone says, hey, we're going to the moon, that's when the market has to move down. And then when everyone shorts and everyone just liquidates their position, then the market turns again. So this is the market psychology that you have to keep in mind. But this video is about not just the emotions of the mass market, but also the emotions of you and controlling those emotions so that you don't make those same mistakes. So I have two strategies that you can use that can eliminate not all emotions, because that is impossible. You are human. It's fine. But two ways that you can use so that you can minimize these emotions when you're making your trading decisions. The first one is just simple. Just set it and forget it. What this means is entering a position, putting a stop loss, putting a take profit, closing down your monitor, not checking up on price every 5 minutes, and just letting the trade run. If you get your stop loss hit, good. You can learn from it and try to enter the market again if you want to. And if you have your take profit hit, great. Buy a drink. So now that's said and forget it. This will eliminate a lot of the emotions that you make, because a lot of these emotions that occur are occurring out of market orders, where traders who see the market quickly going up, they all buy. But If you have already made a trade and you're forgetting it, then guess what? You're not going to make that same mistake because you're not on your monitor. So, and then the second one, which is a post-trade, this is more of a pre-trade thing, but a post-trade thing post-trade technique or strategy that you can use to A, eliminate motions in your trading and in your future trading, and also B, that you can use so that you can learn from previous mistakes. So this only takes about 5 minutes, and I highly cannot recommend enough journaling when you are trading and journaling every trade that you make. So here's an example of how I would journal my trading. So let's say I had just bought, conditions were favorable, and I say the price I bought at, asset class I bought, and then here's just a few reasons why I bought. That's all. Just one sentence. You do not need a paragraph. Just say, I just said because I had seen a demand zone, I'd seen a lot of bullish sentiment at this level, and I had seen a buy volume spike, so I jumped on that buy volume spike, and it went well. I put my stop loss here because it was below the recent tail in the 1 hour. That's all. I put my take profit here because it was a supply zone and I had seen short-term bearish sentiment. And that's why my take profit had been hit. And then after I described the reasons and the rationality of why I did this, I just made a rating system, 1 to 10 scale. How good was my entry? 10 being the best, 1 being the worst. I would say my entry was a 9 as I hit the near bottom low. I would say that my stop loss was a 9 as it was never hit, and it was a comfortable enough stop loss where it wouldn't have been hit unless the market was going to go down. I had a very good take profit at a 7. Why, you might be wondering, wait, why is your take profit and exit different? They should be the same thing because your take profit was hit. Well, take profit I make before the market moves. So this is based on information that I have when I buy into the market. This is based on information that I have after I exit the market and know what happened. So I think my take profit here was a 7 because my reasoning was good, and the supply zone did hold for a bit. But my exit was not fantastic as the market continued to move upward. So this is just a simple journaling exercise that you can use just for a few minutes of your day. That's all it takes. And the really cool thing about this is if you begin to have dozens of these, then you can just flip through them and start to look at these scales and just see when you made mistakes. And then when you see that you made similar mistakes over and over and over again, that you can try to do your best to try to minimize that mistake. And then if you want to go a step beyond there in minimizing the mistake, you can identify the emotion that's attached to that mistake. So reasoning behind that would be like, let's say you keep seeing that your exits are below like 5, that you think your exits are terrible. You can take a step back and say, okay, well, what emotion is causing my exits to be bad? And that's probably the fear of losing profit that I've already made, of having, I'm in a profit and then price turns down, now I'm at a loss. And that's probably the emotion that you're making. And then you can go from there after you write down that emotion in your journal, and then go from there to try to do your best to set it and forget it and just try to hold on to your position a bit longer, time after time, until you begin to believe that your exits are becoming better. All right, so that's going to be it for this video. We've gone over basic emotions that you can see in individuals and in the herd. And then we looked at some visualizations of what the mass market does and how their mistakes can come into play in the market. And then the third thing we went over was 2 strategies that you can use to control your emotions and also to learn from your mistakes. If you have any questions, comments, or concerns, feel free to leave them in the comment section below. And if you would like to suggest a future video, then check out my Patreon. Thanks for watching.